Hey YouTube, how's it going? It's your boy Jose, aka Repugnant Man, and today we're going to be talking about the little book of common sense investing. This is the author John Bogle. He's the founder and former chairman of Vanguard Group, so he's a very reputable guy, one of the godfathers of investing. And we're just going to be looking at the main takeaways, so let's just jump right in. Alright guys, the most ultimate takeaway that I can get from this book is that index funds are good and mutual funds are bad. If you want to know a little bit about the difference between these two things, I'm going to link an article down below from Investopedia where you can learn a little bit more about them. Now guys, if I had to summarize the difference between an index fund and a mutual fund really quick, I'd say that an index fund is something that it's a passive investment, meaning it's just going to track an index, something like the S&P 500, which is like the top 500 companies in the country, right? Versus a mutual fund is something that is actively managed by an advisor, a money manager, and these managers choose what to buy and sell inside that fund. So what that means is that mutual funds oftentimes have higher expenses, higher expense ratios, they have higher fees, while index funds have really low expense ratios because no one's really managing them. They just follow an index. So the first time that the book actually illustrates why index funds are a little bit better than mutual funds is on page 47 in this graph right here, the magic of compounding returns versus the tyranny of compounding costs. Growth of $10,000 over 50 years. So let's take a look at this. So what this graph actually is indicating is that this darker red line really represents an index fund, and this represents a mutual fund down here. And what it's looking at is basically that they both grew at 7% each year for 50 years, and that this one had a 2% expense ratio or cost associated with it because it was actively managed, versus this one was passively managed, so there was really hardly any costs associated with it. Alright guys, so after 50 years you're actually looking at paying $179,900 to your financial advisor or money manager for making all these decisions for you, right? Now I don't know about you, but that's not really something I want to do. So after a 50-year investment period, costs have consumed 61% of the potential accumulation available simply by holding the market portfolio, leaving only 39% for the investor. So you put up 100% of the capital, you assume 100% of the risk, but you earn less than 40% of the potential return. Now this is just to start with mutual funds versus index funds. So you might be asking yourself, okay Jose, why don't I just pick mutual funds that just outperform the market, and even though that I pay certain costs I still get more money? Well, the reality is that mutual funds don't really outperform the market that much. If we look at exhibit 10.1 here, this goes back to 1970 and it shows the 46-year record of 355 equity funds that existed at the start of the period. The first and most obvious thing is that 281 of these funds, almost 80%, have gone out of business. And really what you have here is you have 2 solid winners and 8 marginal winners. The rest of them are either market equivalent losers or just really ceased to exist because they went out of business. So that comes down to about, so it's 10 mutual funds, right? That's like one out of every 35 that outpace the market by more than 1 percentage point per year. And let's face it, those are just really terrible odds. So why would you want to invest in a mutual fund when you're going to pay more in costs and you only have a 1 in 35 chance of beating the market? No, I'd rather just be on par with the market, invest in index funds, not pay a whole bunch of money to a random money manager, and still get a better deal. So basically investing in a mutual fund is kind of like a lose-lose. Alright guys, so the next cool thing or main takeaway that I got from the book is really the importance of dividends. So right here we're looking at a graph that's illustrating $10,000 over from 1926 all the way to 2016. And basically the darker line is one that reinvests the dividends plus the return, and then down here the dotted line is one that was just without the dividends being reinvested. So what you have here is the 10K, when you reinvest the dividends that you get, goes all the way to $59.1 million, versus if you actually didn't reinvest the dividends, it's just at 1.7 million. So there you go guys, make sure that when you're buying stuff in your retirement portfolios or in your retirement accounts, investment accounts, that you choose the reinvest dividend option so that your money's going to grow and compound way harder than it would without it. Alright guys, now we're going to be looking at this graph right here, which is, it's talking about that importance of dividends and it's tying it back to mutual funds versus index funds and how dividends are affected in there. And that's something that this book always does. It always ties everything that it's teaching you and everything that you're learning, and it ties it back to how that applies to mutual funds and index funds. It's really the whole theme of the book. Alright guys, so when looking at this chart here, you have actively managed mutual funds here. You have an actively managed growth fund here. You're going to see that the gross dividend yield is going to be about 1.3%. But if your expense ratio is also 1.3%, what actually happens is that you're actually getting 0% in the dividends back, right? 100% of that gross dividend yield is being consumed by the expenses, versus a low cost index fund. You have a gross yield of around the same 1.4%, but the expense ratio is only 0.1%. So your net yield is 1.3. You're only paying 4% share of gross yield is going to be consumed by expenses in the low cost index fund. Again, and when you realize how much dividends make your nest egg grow, you realize just how much in terms of dividends low cost index funds are better than actively managed funds. But guys, that's really it for the video in terms of what I learned and my main takeaways from the book. There is so much more. I didn't want to keep this video short though. The author goes into ETFs, exchange traded funds, and he doesn't really like them that much. He thinks they promote too much volatility and buying and selling, so he doesn't really like them that much. He also predicts what he thinks is going to happen in the future of the economy, how he thinks the returns aren't going to be as high as what they once were. And there's just so much more in the book. If you're really interested in learning about investing, I highly recommend this book, guys. Common Sense Investing by John Bogle. It's a great book. Guys, this video took me a while to make, to get put my notes together, figure out which graphs I really stuck with me and which graphs I think were important for you guys to see. So if you guys can please like down below, I'd really appreciate it. Comment down below, tell me a little bit about your retirement journey, well, a little bit about investment, and let me know if you're going to pick up this book, or let me know what investment books you're reading. So anyway, guys, thanks for watching and have a great day. Bye bye.